Hi, welcome to the Peak Wealth Podcast. I'm your host, John Perry with Steel Peak Wealth Management. Today, I want to spend a few minutes and just talk about where the markets are year to date, give some insight as to where I think things are versus where they're probably going. It's a very interesting dynamic we have going into the summer of 2024. The markets have done very well coming off of a pretty great 2023 after a horrible 2022. People really might not realize this, but 2022 was a historically bad year for not just the stock market indices, but for the bond market as well. It's only the second time in 30 years that the major stock indices and the aggregate bond market were down double digits. So that is an epically bad year. And 2023 was a great rebound year. And now so far, we've started 2024 with also a very, very strong market. For our reference, I'm going to use the S&P index as the benchmark for when we talk about performance. It's the indices that most people refer to first and foremost. What people don't realize is how the S&P is put together. Obviously, it's 500 stocks, but it's not just 500 stocks that all have the same weighting, as we say, in the performance of how that index does. It's actually what we call a market cap weighted index. And what does that mean? It means if you take a stock's market price and multiply it by the number of shares outstanding, you're going to get its value in the S&P. And that's going to give its market weight. And so as time goes on, you can have different stocks and even different sectors having a greater impact on the performance of the S&P. And that's generally what's happened over the last decade or so, where we've seen the tech stocks, and I'm going to reference the Magnificent Seven for the last few years. That's something that investors probably have heard a lot, written up, talked about on CNBC or Bloomberg, and we've got some charts to go over what I'm referencing when I say the Mag 7. The Mag 7 has pretty much become synonymous with the performance of the S&P over the last couple of years, and they are pretty much all household names that are represented in that small grouping. So think about it, 7 stocks out of 500. And I want to show you what kind of influence or impact they have on the overall performance of the index. So if we can put that first chart up, and what we see here is these are the stocks that make up the Mag 7. And again, Amazon, Alphabet, Microsoft, Apple, Tesla, Meta, or Facebook as it used to be known, and the new darling of the market, NVIDIA. Okay, these stocks now constitute about 30% of the performance of the S&P. And if you look at this chart that's on there right now, you can see that if you take on the top there the performance over the past 5 years, it's averaged 75%, okay? I'm sorry, 271% for 5 years versus 90% for the S&P. So that's dramatic outperformance. So what basically has happened? Well, because they've grown so much, they've continued to have a bigger and bigger impact on the S&P's performance themselves. If we go to the next chart, uh, we can see that this is the actual growth of these 7 stocks since 2014. So starting at about 13 and change, now up to 28% as of the end of last year. That's the impact. 28% of the performance is just from these 7 stocks out of 500. That is unbelievable. And what that has really done, it kind of shows everyone that these stocks and generally technology has really been driving the performance of the S&P over the last 5 years. If we go to the next chart, again, I have a breakdown of what really the makeup of the holdings are individually, and you can see again the Mag 7 all make up the greater percentages of the top holdings in the S&P as it's constituted as everybody sees it. Now, what a lot of people don't know is that there's another index that is representative of the S&P 500, but it's what we call an equal weight index. And that index basically takes, as it sounds, all of the 500 stocks and treats them equally. So each stock has the same percentage weighting in that index, and thereby, regardless of how they perform day in, day out, year in, year out, that's not going to change, even as that price goes up or whatever the performance of the underlying stocks might be. So if we go to the next chart, what we see is that you take the holdings of the equal weight S&P, and now you can see percent of assets. And these a lot, again, will be a lot of stocks that people have heard of, FedEx and Eastman Chemical and Domino's Pizza. All of them are going to be in there. Apple and Microsoft, NVIDIA, Meta, they'll still all be in there, but they're all going to have this same weighting in the index. Now let's look at what the performance has been. In the next chart, I'm going to show you the performance of what the classic S&P market weighted index has done. So year to date, it's up over 11%. And for the past 1 year, what we call the trailing 1 year, it's up over 26%. Now, if we look at what the equal weight S&P has returned, you will see a stark difference. And this really tells the whole story. So these are the same 500 stocks, but this one is market cap weighted, and the next one is equal weighted. And there you have it. Year to date, not even up 5%, as opposed to 11.5 approximately. 1 year was over 26% for the regular S&P, and for the equal weighted at 17%. Results that are still not that bad, but you can see the dramatic outperformance of the market weighted S&P, and that is almost entirely related to the impact of the Mag 7 over the course of the year to date. And again, when we look at the last 5 years, how much the S&P has its performance attributed to these stocks. So what does that mean going forward? Really, in my opinion, and I've been doing this for 30 years, at some point, we hope the other parts of the market catch up, and the other sectors, I mean. And those are things like healthcare, energy, telecommunications, all these other areas that have really lagged behind and have not consistently performed like technology has. Now, we still have a number of areas like AI and biotech that can drive performance dramatically in the S&P or in another index like the NASDAQ, which is represented by QQQ in terms of an ETF. But the line of thinking is at some point, we want these other areas, the financial stocks and healthcare, to start having more of an impact. And that probably means that there's a shift in people investing just so much in technology and so much in the Mag 7, and there's a balancing out of the rest of the sectors in the market. Is that going to happen? It probably will at some point. But when you have some of these AI companies, and that area includes Microsoft and Google and NVIDIA and AMD, these stocks that are either the platforms or the picks and shovels of AI, which is really the buzzword of the moment. But we really do hope and expect that at some point these other areas are going to catch up in terms of performance. So that's really a little bit of where we stand today, what my insight is in terms of where I think things might go. Keep in mind, the episodes of the Peak Wealth podcast are available on Spotify, Apple, and YouTube. So if you want to go back and look at any of our other episodes. Also, if you have any questions, as you see on the screen, feel free to email me at john.perry@spwm.com. Thank you for listening, and we'll talk to you again soon. Ice cream.